In this lecture, I'm going to show you about the kinds of data that you can get on individual securities from public websites, and how you can use that data to get the inputs needed for some of the techniques that we've discussed so far. In particular, we will start by considering a statistical model of returns. This model will have some parameters which correspond to variables we've discussed in the past. For example, these variables will allow us to calculate covariance. We will then discuss how to estimate these parameters using data on past returns for securities. This technique is known as regression analysis. With the estimates from regression analysis, we will be able to quantify the characteristics of a security. This will be useful for understanding the security's risk and perhaps the mispricing it might have relative to an asset pricing model. In this lecture, I will show you how to use these estimates to quantify the variance-covariance matrix that is useful in forming optimal risky portfolios. Versions of the output of this process that we develop in this lecture will be available on websites. While you could simply use these outputs, I want you to have an understanding of where these numbers come from. My hope is that once you see that, you'll have a healthy appreciation for what these numbers mean. To start, let's develop a simple statistical model to describe the way security returns behave. With such a model, we'll be able to build up the variance-covariance matrix. It will be useful to think of the information we have as coming from what is called a data generating process, or a DGP. A data generating process is just a mathematical description of how the observed data is generated. The simplest data generating process is the following. The return on a specific security in excess of the risk-free rate can be divided into two independent sources. One, the first source is common across all securities and is related to general features or happenings in the economy as a whole. These features include things like the level of interest rates, the amount of GNP growth, and the level of input prices, like the price of natural gas and petroleum products, and so on. The second source is specific to a particular firm. This source is idiosyncratic to that security rather than common across all securities. These things might include things like the fact that the CEO is going through a divorce and she is a bit distracted, more distracted than usual. Or that the team of R&D specialists has made a technological advance that will make their products more reliable than their competitors. To keep the model simple, we will aggregate all of the individual common factors down to one factor, which we will say is the market factor. Since it is hard for us to have a good idea how all these individual common factors aggregate up, we will simply let the market tell us that and use some broad-based index of security prices as the market factor. For example, we could use the return on the S&P 500 to indicate all of the things that affect the market. There are a couple issues that you might be thinking about with respect to the S&P 500. First, if each of the securities in the S&P 500 has idiosyncratic factors, won't the index also have a bunch of idiosyncratic factors? But even though the S&P 500 is comprised of individual securities, the idiosyncratic things won't really matter that much in the index, since all of those things are going to sort of average out. Second, the S&P 500 may not be representative of a sample of firms throughout the market as a whole. The S&P 500 firms are the largest firms in the economy. And large and small firms are likely to be different and face different challenges and be affected differently by various different economic challenges and conditions. Thus, the S&P 500 may not be a good aggregator of all the common factors. You could get more complicated and use a more broad-based index like the Morgan Stanley Capital International or the MSCI All-Country Index. Also, you could use some combination of the NYSE, NASDAQ, and Amex stocks, which represents essentially all of the securities available to be traded in the United States. Of course, if you look at the correlation between all of these indices, and they're all very high, exceeding about 90 to 95%. For simplicity, I'm going to use R sub m to denote the return on the market, where you can decide which data that you want to use. All of these data sources are readily available on the web for either the NYSE, NASDAQ, and Amex, or for the MXCI. Now that we have a common aggregator for all the common factors, how do we get the idiosyncratic factors for each individual security? That must be a monumental task. Well, if you think that you have all the common factors appropriately aggregated in the market factor RM, then it's actually very easy. The idiosyncratic component of return, by definition, is simply everything that is not explained by the common factor. We can summarize the DGP via a mathematical expression as follows. The return on the individual security minus the risk-free rate is equal to the alpha on that individual security plus a coefficient beta on that individual security times the quantity, the return on the market, minus the risk-free rate, plus something I'll call epsilon sub I. In the expression, RI is the return on the individual security. RF is the risk-free rate. So RI minus RF is the return on the security in excess of the risk-free rate. The common factor is the return on the market, RM, in excess of the risk-free rate. So the common factor is RM minus RF. For example, if the market return is 10% and the risk-free rate is 3%, then the excess return on the market is 7%. If the return on an individual security is 12%, then its excess return will be 12% minus 3% is 9%. That would be the excess return on that individual security. This model is called the single factor model because there is just one factor that explains the returns on the securities. In this case, the single factor is the return on the market. This single factor model is also called the market model. Although every security is affected by the common factor RM minus RF, the amount that is affected by RM minus RF can vary by security according to the beta sub I, the coefficient on the common factor in the expression. Thus, the amount the ith security is affected by the common factor is going to be beta sub I times RM minus RF. For example, Steve Co. might have a beta equal to 0.5. Albie Co. might have a beta equal to 1.5. Some securities, for example, Catherine Co., might have a negative beta, for example, beta equal to negative 0.3. Thus, if the excess return on the market was 7% in a given period, then the component of return for Steve Co. will be 0.5 times 7%, or 3.5%. For Albie Co., it's going to be 1.5 times 7%, or 10.5%. And for Catherine Co. will have an excess return of negative 0.3 times 7%, or negative 2.1%. That is, since the market went up, the return on Catherine Co. will be negative. By the way, what explains the variation in betas across securities? You can think of the beta as summarizing how the return reacts to market conditions, as summarized by the market return. For example, an airline firm is likely to have a very large beta. A significant fraction of profits from airlines derive from business travel. This kind of travel is not very price sensitive. It is typically scheduled at later notice, and the prices then are not discounted. Thus, if the economy is booming, there is likely to be significant business travel, which raises profits. At the same time, the market will be up, reflecting generally rising profits for everyone. Thus, given the higher profits to the airline, the return on the airline will be high when the return on the market is high. But the market also includes a bunch of firms that are not as sensitive to the boom or the bust cycles of the market as a whole. Thus, the market return will be the average sensitivity of all firms. The airline will have a greater than average sensitivity. Thus, the airline will have an amplification of the market, and it'll have a beta that's greater than 1. Now, consider a grocery store. It sells about the same amount of food when the economy is booming as when it was in a recession. However, it may sell more luxury items, those with larger profit margins built in, when the economy is booming versus when it is in a recession. Thus, the beta of a grocery store is likely to be positive, but not nearly as sensitive to the economy as, say, an airline. So while the airline return will be an amplification of the market, the grocer will be a damped version of the market. So Steve Co., in our example previously, is a grocer, while Albie Co. is an airline. By the way, since I like to cook, I let Steve Co. be a grocer. Albie is my dog. He's a giant Bernese mountain dog, And he's fairly sedate, but he overreacts when anyone comes to the door. That's why I gave him a beta bigger than 1. What about Catherine Co? Well, Catherine's my wife. Early in our relationship, this is 1,000 years ago, she was in law school and worked as a lawyer for many years after we got married. While most law firms are partnerships and not publicly traded, I was able to effectively have, and I hesitate to use the word, but here goes, ownership in the security of a negative beta security. She worked for a firm that represented plaintiffs in security fraud cases. Most people don't sue when the market is up. They don't even look to see if there's anything wrong since they're making a lot of money. But when the market price is down and the security price is down, that's when people tend to sue. And if the whole market is down, there's even more people that like to sue in that case. So when the market was down, her firm made more money. When the market was up, her firm made less money. And since her bonus was tied to firm performance, my return was low when the market was up and high when the market was down. That is, there's an inverse relationship. The beta in her data generating process is negative. As we've seen, negative correlation is useful. It allows you to shift the efficient frontier farther to the left. It allows you to reduce the amount of variance for a given amount of expected return. And a negative beta indicates negative correlation. Since the returns on Catherine Co. are negatively correlated with the market, I was able to shift my efficient frontier more to the left than most people who can't trade in securities law firms. She, by the way, thinks I to this day, married her for love. By the way, I've yet to gaze into her eyes lovingly and say, darling, you have the most beautiful negative beta. This is going to be our secret. Okay, back to the math. In the expression, there are 2 other parts to the data generating process. The alpha sub I is a constant component. It says that the excess return for the security has a constant component that doesn't change with the market as the market moves. We'll discuss later how to interpret the value of alpha. The second other part is everything else, the idiosyncratic part, all the stuff that is not explained by the market movement. So going back to the examples, let's say that Steve Co. that has an excess return of 9%, its raw return was 12%, and the risk-free rate was 3%. Its beta is 0.5, and the excess return on the market was 7%. So the common component is 0.5 times 7%, or 3.5%. Let the alpha for Steve Co. be 0. Thus, the idiosyncratic return must be the epsilon such that 9%, the return on Steve Co., is equal to 0, plus 0.5 times 0.07, the 3.5%, plus epsilon. In this case, epsilon is going to be the 9% minus the 3.5%, or 5.5%. Thus, given the beta of 0.5, it must have been the case that there was a lot of good idiosyncratic news on Steve Co. The market being up was good news for Steve Co., but there must have been some extra good news specific to Steve Co.'s business that boosted the return over 3.5% due to the market being up. So with the single factor model, we have 2 sources of variation in returns, the market and idiosyncratic returns. With the single factor model, we have 3 parameters that characterize the nature of the relationship between returns and these 3 sources. The first parameter is alpha sub I. The second is the beta. The third variable of interest is the variance of the idiosyncratic part. We need to be able to estimate values of alpha sub I, beta sub I, and the variance of the idiosyncratic part for a bunch of securities. Numbers corresponding to the beta are readily available on the internet. For example, if you go to Yahoo Finance and type in the name of a company to get to their page, it will provide you information on the betas for those companies. There's a list on the left-hand side of the page that lists separate pages of information organized by type of information. Under the Key Statistics link, you will find the beta for a security. You need to be a little careful when you look at these betas, as sometimes they don't make a lot of sense. Depending upon which site you look at, they estimate the betas differently. Many sites make ad hoc adjustments that produce kind of odd estimates. Once we see the basic technique for estimating a beta, I will revisit why the numbers on the web may seem a little bit odd. All of the parameters that characterize the security return can be estimated using a statistical technique called regression analysis. Regression analysis is a process whereby you let the data determine the best relationship for fitting the data. To see exactly what that means, let's consider a bunch of data we have on a particular security. Think of a plot of the monthly return on, say, Dell Computer against the monthly return on the market. To make this concrete, let's say that for every month I collected a pair of returns for Dell and the market. You can do this too. Yahoo Finance and Google Finance both allow you to download data on the returns for many individual securities into a spreadsheet. Once downloaded, I'm going to subtract the risk-free rate that applies during that month from both the return on Dell and the return on the market. I use the T-bill rate for securities maturing in a month for the risk-free rate. Make sure that if you download monthly data, the risk-free return is not annualized. Rather, it should be the effective monthly rate to correspond to the monthly return that you have on Dell and the market, for example. Data on the risk-free rate is hard to find. Also, the return on the market is also a little bit hard to find, depending upon how you want to define the market. Kenneth French's personal website has a data library section that provides you data at a variety of different intervals, like annually. The data is periodically updated to include the most recent periods. All you have to do is Google Ken French's website and you'll find this data. As you will see later, this site also provides other data that are extremely useful for the types of analysis that we're going to be discussing in later lectures. I highly recommend Professor French's website. Once the data is obtained, for each Dell market return pair, plot Dell's return on the vertical axis against the market return on the horizontal axis. Any spreadsheet program will have a routine that produces such a scatter plot. If you do this, you will get a scatter plot of points. It will look like a shotgun shot at a piece of paper. Lots of dots all over the place. Hopefully, the scatter plot will have some trend to it. Regression analysis seeks to find the single straight line that fits that scatter the best. Okay, so what do I mean by best? By best, I mean that the average size of the errors about the line are the smallest. What do I mean by error? In regression analysis, we divide the data into two categories, the dependent variable and the explanatory variable. The dependent variable is the thing that we're trying to explain. It's the variable that depends upon the variables whose variation explains the variation in that variable. In the single-factor model, we're trying to explain the return on an individual security, given what? The common factor, which is the return on the market. The return on the individual security is then the dependent variable. The return on the market is the explanatory variable. The error is the difference between what the explanatory variable predicts and what actually happened. Again, consider a plot of Dell against the market. Draw a line through the scatter. Then, for a particular observation of the market return, read up to the value of Dell that is on that line. This is the value predicted by the line that you drew. The error is the difference between the actual return for Dell for that observation and the predicted value for Dell that you got off the line. For example, let's say that one observation for Dell in the market is 4% for Dell and 10% for the market. Let's say you drew a line such that the line predicts a 10% return for Dell. Since the actual return is 4%, the error is going to be 4 minus 10% or minus 6%. If you do this for every observation, you will have a series of errors for each observation. Regression is all about finding the best line. So let's see what criterion this analysis uses for determining that best line. The criterion used is to pick the best line in terms of the sum of squared errors. By the way, this is equivalent to looking at the mean squared error, which in this case is simply the sum of squared errors divided by the number of observations. Regressions pick the single line that has the smallest sum of squared errors or the smallest mean square error. That is, it picks the line that fits the data the best in the sense that the errors from the line are the smallest on average. Now you have to be careful with regression analysis if there are things called outliers. Outliers are observations that are really sort of out of the ordinary. For example, an observation on the day of a market crash or a day where something extreme happened in the firm. If you're trying to predict the relationship that will occur during normal times, then you may get misleading answers by using the whole data if you don't recognize the fact that you have an excessive effect with an outlier. To see this, consider again a scatter of the data that has an upward trend that is fairly clumped together. But in addition to this main clump of data, there's a single outlier that is for a day in which the market soared, but the firm fell very sharply. This might have been a day in which the CEO died in a plane crash. Very bad news. But Ben Bernanke said that we would continue to keep money supply very loose. This is really good news for the market. This observation is very far away from the rest, and it's very unusual. It's hardly a normal circumstance. If you had to pick a line that fits best in terms of mean squared error, you would have to pick a line that goes through the outlier. Because the outlier is very far away from the others, if you don't put the regression line through that outlier, the outlier is going to have a gigantic error. And when you square that error, you get gigantic squared, which I think is ginormous. If you fit a line through the outlier, then the regression line will indicate a negative relationship in this case between the return on the firm and the return on the market. That is, the estimated regression will indicate a negative beta. But remember, the data was upward sloping. The real relationship is such that the scatter was upward sloping. All but one of the days of the data indicated there was a positive relationship between the return on that firm and the return on the market. The outlier should be completely downplayed, if not completely ignored. If the regression is re-estimated without the outlier, the regression line will go through the normal cluster of data and have an upward slope. This is much more accurate reflection of the actual relationship. I suggest looking at the data by plotting and looking for outliers. Similarly, when you get estimates of beta off the internet, I suggest you look at the data to see if the estimates are from anything sort of sensible or whether they're maybe subject to outliers too. Once you have the best alpha and the best beta from the regression analysis, we can also get the variance of the idiosyncratic terms. Recall that the errors are just the difference between the line and the actual data. If the regression line is the relationship between the return on the security and the return on the market, then the regression errors are simply those idiosyncratic terms. Thus, the mean squared error from the regression is the variance of the idiosyncratic part. This number will be important later in the course when we discuss active versus passive management. If you estimate a linear regression single factor model for a set of securities, now you're going to have enough information in order to write down the variance covariance matrix. Recall that the variance covariance matrix is simply a table of variances for each security and the covariance of each pair of securities. Now, you could create such a table in a spreadsheet. You would list the securities across the top and down the side. The first entry in the table would correspond to the first column for the first security and the first row, also for the first security. That entry would contain the covariance between security 1 and itself. This is simply the variance of the first security. The next entry over to the right would correspond to the first security from the first row and the second security from the second column. This entry is the covariance of the first security with the second security. Similarly, the entry in the second row and the first column is the covariance of the second security with the first security. By the way, this is just the same number as the covariance of the first security with the second security. Thus, the matrix that we built in the spreadsheet table is symmetric around the diagonal. The diagonal elements are the variances of each security. Above and below the diagonal are mirror images of each other, since the covariance between, say, security I and J is equal to the covariance between J and I. Also recall that you can use the variance covariance matrix to form efficient portfolios or minimum variance portfolios. To get the variance covariance matrix, you need to calculate the variances for each individual security. then we need also to calculate the covariance. First, let's consider the variance. Remember that the data generating process for the security is R sub I minus RF is equal to alpha I plus beta I times the return on the market RM minus RF plus epsilon. Based on this expression, we can calculate the variance of the return on this security. There are only two sources of variation in RI. Alpha is a constant by definition, so it doesn't vary. Since beta is a parameter, it presumably doesn't vary either. But RM does vary. The variance component that's due to the variation in the market return is going to be the beta for that individual security squared times the variance of the market return. That is, recall that the variance is the expected value of squared deviations. Since we want to get the variance of the deviation caused by the common factor, and the common factor is multiplied by the beta, we get a beta squared times the variance of the common factor. The second source is from the idiosyncratic part. The idiosyncratic part is all of the variation that cannot be explained by the market movements. The variance of the idiosyncratic terms is then simply the average or the mean of the squared errors. Any regression output from any statistical package, say from a spreadsheet program, will have this labeled as MSE for mean squared error. Let's simply denote this variance by sigma epsilon sub I squared. Then for any asset I, we have the variance of the excess return is equal to beta I squared times the variance of the return on the market plus sigma epsilon sub I squared. Thus, from the regression output, you can decompose the variance into two components. The part that is due to systematic or common factors, that's the beta I squared times the return on the variance of the return on the market. The second part is due to the idiosyncratic factors, that's the sigma epsilon sub I squared that you get as MSE off the regression output. If you're going to take an active position in a security that has a significant portion of its variance from the idiosyncratic component, then you should realize that you're going to take a large position in that security and you're going to be bearing idiosyncratic risk that you would normally diversify away if you simply held that security in a market-like portfolio. In a subsequent lecture, we'll examine exactly how you should use the information on the idiosyncratic variance when forming an optimal portfolio with active positions. Next, let's get to the covariances. To see how to calculate the covariances, line up the return expressions for any two securities. If you do that, you can see that the only thing they have in common is the return on the market, RM minus RF. The constants, alpha 1 and alpha 2, don't vary. By definition, they're constant. Also, epsilon 1 and epsilon 2 don't covary because they are due to things that are unique to each firm or security. When epsilon 1 is negative, say for example the CEO was discovered committing fraud, that tells you nothing about any of the other unique things that might be happening at the other firm. Thus, the only source of covariance is the return on the market minus the risk-free rate. Since one moves at a rate of beta 1 and the other at a rate of beta 2, given movements in the market, the covariance is simply beta 1 times beta 2 times the variance of the return on the market. So once you have a set of regression outputs, one for each security, you can form the variance-covariance matrix for a collection of securities using the output of these regressions. Note that a K by K matrix has K squared entries. For 10 securities, that's 100 different entries. But to get those entries, all you need to know is 10 betas and 10 idiosyncratic variances and 1 variance for the market. That's only 21 outputs from regression. If you have 100 securities, then you're going to need only 201 parameters from the regressions. And that will allow you to determine what? 100 times 100 different entries in the variance-covariance matrix. That's 10,000 different entries. So, in addition to being able to characterize the variance and the covariance of many securities, the regression output also provides estimates of alpha. As we will see in the next few lectures, asset pricing models has implications regarding what the value of alpha should be. We also see that if alpha is not what it should be, then there may be a trade strategy that can generate some excess profits. In order to optimally exploit such trade strategies, the information on the variance component and the betas we obtain from the regression analysis will be very important. We will discuss how to use these estimates over the next few lectures.